and a warm welcome to one and all. And if this is your first time here, I am the coffee obsessed Scruffy Trader. Why? Because we all know Scruffy likes a coffee, and he does, and he loves the charts as well. And today is a little bit different for you. It's a replay of a live stream that I did recently for the Scruffy Squad. Now, as many of you know, I don't trade the way that is kind of peddled out in the mainstream. I do it my way, and I earn a living from it my way. And this might give you a little insight into how I help the scruffs and also how I view the markets. So if you want to see trading in the real world, do take a second to smash that little subscribe button. If you want to see future updates, drop in the description. You'll find my Twitter feeds, and also click the like. Genuinely helps me to, well, motivate me to do more, I guess. So please take a moment, have a good read through it, have a look at the live stream, and I cherish your thoughts in the comments below, because I genuinely answer every single one, as I do any contact that comes to me, whether it's email or direct message. So enjoy.
Well, we're waiting.
Okay, boys and girls, hope we well. It's just a few minutes to the top of the hour. Can I just do a quick sound and visual check? That'll be great. All good here. Excellent, excellent. I'll just flick this over onto the whiteboard. Can I have a visual check and a sound check with the whiteboard? Let's have a quick look, see who we got. Yep, all good. Excellent. Hey, this modern technology, getting better, getting better. Well, you can call what I do is getting better. Anyway, we'll give it a minute or two. Just let a few people drift in and see who we've got in the meantime. Oh, Yanis, good morning. Volker, hope you're feeling better, my little friend. Damien, Hardy, Dwayne, Steph. Oh, we up and running. Hey ho. Let's have a look. See what this is. Volker, what's that? You're not at home sitting with the tablet, don't know. Are you away on your jollies, or is it work, or is it just family? Oh, he's big balls as well. How are we doing, son? And a very happy birthday to the little one. Good stuff. Good stuff. Strong. Okay. Happy days. Happy days. Strong. Oh. Right. Family weekend. Ah, good at that. And a good morning to Philip and Andrew as well. Okay. Well, what we're going to do, we're going to talk stops today and give you a couple of different ideas on ways to look at it. So let me flick up on the whiteboard and we'll go through what it is we're going to have a wee little chat about. Okay. All right. So get your coffee in hand and we'll have a little wee chat about this. Now, stops for me is probably one of the hardest subjects to talk about because everybody has an opinion on them. And not only do they have an opinion, they can be, how do I put it? You're on two sides of the fence. Are you going to be tight or are you going to be wide? Now, I swear to the wide side because I genuinely think stops are death by 1,000 cuts if you get it wrong. But on the other point of view, you can look at it as, well, I've got a mental stability where I can sit through a lot of pain, in other words, these 1,000 cuts, but then get the big runner. The problem with trading is not many people can do that. It's a hard thing to do because I'll give an example when I get onto madness. What if all of those cuts came at once? Would you press the trigger again? or would you tinker with it? I don't know. But what I would suggest is keep your comments coming in, and I'll stop periodically when I get back to the screen and we'll go through them. But basically, when you're looking at stops, you've got to ask, what is its job? What is the job of a stop? Now, most people can't really answer that. They just go, well, it's risk reward, or they'll give a wishy-washy answer. It has one job. One. And this is why I don't look at stops and profits together. For me, they are completely separate. Why? Because the profit is the return on an investment, but the stop has one job, and I'll see if anybody can get it in the comments before I sit down. But what it for me is, it protects the account. That's it. It has nothing to do with your trade. Not a blind thing. All it means is you made the wrong decision. It protects the account. That's it. And I know this sounds a bit of an odd way to look at it, because people say, well, no, you have to put your stop at a certain place, and then you calculate how far it is to your entry. That gives you your risk reward, and the risk reward gives you your position set. Well, I don't subscribe to any of that. I think that's all horseshit. And I genuinely do. Your stop needs to have a money value against it, which is your investment, and your profit is what that investment makes. If you go into the market thinking, well, this has any relation to your trade, you probably got your position size wrong and the trade wrong. Why? Because your trade has to be right in the first place, not the stop. I hope that makes sense in a strange way. I genuinely do. But when I go on the screen in a second, I'll kind of show you what I mean by this. So what I'm going to go through is 4 versions of a stop. Okay, we're going to look at a fixed. Should you have just a standard 10 pip stop, 20 pip stop? Does this work? Who knows? We'll discuss it in just a second. A moving average stop, which can help you quickly identify breadth of market and understand how a stop can be placed without putting too much thought in it. The same with a Donchian channel. Now, a Donchian channel is really good for recognizing stops, because this aligns itself a little bit with the way I put stops in, which is by market structure and levels. And then finally, that's what we're going to look at, points of attraction. And I have points of attraction ×2, because that is exactly how I do my stops. So I hope that makes sense. Let's drop it down onto the screens, and then I'll be able to read your comments as we go, and we'll work our way through it. But like I say, just keep dropping your comments in, and I'll catch them up as best I can, because sometimes there's a little bit of a delay on the chat box, and at least if they're there, I can scroll into it. Okay, so let's have a little look, shall we? Okay, let's flick this over. Okay, so get rid of these for now. I've just got gold on as an example. Let's have a quick look, see who anybody else has dripped in. Morning, Ryan. Hello, Alex. You've just got in. Well, wake up, you lazy git. And John and Stephen. First live stream. Well, very welcome to the first live stream. It's a bit chaotic at times, but just strap yourself in, son, you'll be all right. And morning, Andrew and Charlie. Hello, Charlie. It's a shame we're going to miss you when we're on holiday. We're going to miss you by a few days. But who knows? I'll make the effort to get to Manchester and catch up with you in big balls. How's that? Okay. As I was saying, when we're talking about stops, and John has answered it correctly in the chat there. Stops for me is all about just account protection. That's it. If I start placing that into the trade itself, it kind of skews my decision. And I know it sounds a little bit odd, but I like to look at a clean chart, understand the chart, and understand the trade before I consider where the stop's going to be. In other words, I look for the direction. I look to see if there's a pocket of air between two levels or 2 points of attraction. That could be the bottom of a Bollinger Band or the moving average, whatever. It all works together in symbiont of the trade. But then you need a contingency plan, and your contingency plan is if it is wrong. And that's what a stop is. And that's kind of the best definition I can give of a stop. For me, working out risk reward and using the stop to get your position size, I think all of these elements should be in place before you look at your stop. And then that way it makes your trades a little bit easier. Okay. So I said I would start going down through 4. Now, if you have a fixed stop and it is, I don't know, say it's 20 pips. How do you know that that fixed stop of 20 pips is right? Well, you don't. The only way you can kind of figure that out is with an ATR. So if you drop an ATR on and you're on a single market each time, in this case, gold for argument's sake. So if I drop an average true range on, okay, and I take this out to the daily, it's telling me it has an average true range of 24. So how do you work out a fixed stop from this? Because too many times when I'm watching sort of chitter chatter in various sort of groups or whatever, so I just use a 10 pip stop and I'm fine. Are you though? Did you make any money from it? How many times did it hit your stop? How many times were you right? They can never answer it because it's just plucked out of thin air. But if you are going to go down the route of a fixed stop, it has to be specific to a market. So in this example, we have gold. And what we're kind of looking for is a breadth. So if you, I'll just widen this out a little bit for you so you can kind of see it. I'll get rid of all the levels just for now. There's a breadth of market. In other words, we know where the market opened, which is this point. Okay, so the market opened there. Okay, on the point of it opening, as we say, it's approximately 24. Okay, so if I measure out 24 there, all right, and I just drop another line sort of here at the base of it, and then another line above it, that is a trading arena with a breadth of market. Because when you're going into the market, you understand that the ATR, however far that it moves, can go 24 either way at that point. So what could your fixed target be for the day? Well, to me, it would be about 25 to 30. Why? Because I want it on the other side of these lines. All right. And then tomorrow, because I work it off a daily chart in this instance, it's a fair bet the ATR is going to be roughly around the same. So therefore, you could just stick with a 30 pip stop fixed, if that's what you so wish. But if you went into this thinking, well, I'm going to use a 10 pip stop, well, you're putting yourself in front of the train every time. because this can easily go that way as much as it goes that way. I hope that makes sense. And the idea behind what I'm trying to illustrate is to get you to think that sometimes there's another way. And that's what this is all about. So a fixed stop isn't just, well, it's 10 pips, it's 20 pips every day. A fixed stop could be breadth of market. Does that make sense? And I'm going to pull up Scruffy Madness just to kind of illustrate fixed stop against stage stop and a wider stop as well. And it should hopefully illustrate it. Okay. So as we were saying there, so what do we say? The breadth of market is 25. So I'll work on a Scruffy Madness of 30, and we'll take a fixed stop of, say, 15, you know, because that's what people say. Let's have a look. We'll play with some figures. So you're on $5 a point. You're going to go, well, I think everything is 15, just for argument's sake. Right, risk reward. What are we working on? Should we go 2, 3, 5? Everyone says 2. So we'll do 2. Just for silly figures. Right, okay. So let's have a little look to see what a standard fixed stop will do for you. Well, let's get it to break even. Drop them out. Let's have a look. It's going to be there. So your break even point is 4. 4 out of 10. Let's say a couple of new ones come in. Morning, Rory. Morning, Mark. So 4 times out of 10. And you think, oh, okay, I can live with that. But could you? Think about this logically. If you lost 6 in a row, boom, 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 will you pull the trigger on that next trade? The chances is no. You'll be fearful. So you'll tinker with your trade, and what you'll have a tendency to do is mess around with the stop as well. So all of the good work that you think you're doing is probably getting unraveled because it looks good there, but in reality it isn't good, because it all comes down to the human psychology, you know. And as I said at the start, there's not a lot of people can take 1,000 cuts. It's just, it's fear, I guess, is the big emotion that I'm looking for. But look at it this way. If you said, right, okay, I'm working on the same sort of target, so 30, but I've looked at a breadth of market using an ATR, and I know it's 24, 25, and I'm going to go 5 pips above that, which is 30. All right, and the reason why I'm showing you this is I want to show you what a fixed stop, but a wider fixed stop, can give you against a tight stop, because it is very, very, as the guys are just sort of pointing out here, stressful. And stress is terrible, and it's all created from your stop. You know, it's not your win rate or anything, it's your loss rate. That is quite important. So what we're looking at here is you've widened the stop out. Your target's the same and your bid size is the same. Now, if this moves and we just drop that back, what happens is it allows your trade to breathe a little bit, but your stop is in the correct place. In other words, it's outside of the breadth of market. But your risk, if you are looking at this sort of from a money point of view, you can sort of say, oh, well, it's costing me more, but it's not really, because you're gaining so much more on the upside and your risk return is better as well. So you can manage your stop in such a way that it's still in the same criteria of being fixed, but it's spaced out. And it doesn't matter which of the ways that I'm about to pull up, this works out. And the part that I like the best about Scruffy Madness and managing trades, and the reason I brought it in first, is because, well, a lot of people ask about management of trade. This to me is management of trade. It's putting the stop out of the way and then managing the position into it. And ultimately, my risk reward is better, but my break even also pays me. Whereas a fixed stop won't. Well, in this case, where it's 100% exposure in a fixed stop. Does that make sense? You know, and just looking at here, Andrew said, it's still costing you a $5, but it's not all the one. Yeah. The way a madness works, Andrew, is very simple. If you're going into the market originally here, you're 100% exposed at point of entry of the market. In other words, all your eggs are in one basket. Right? If that market moves against you, you have nowhere to go. You have to ride out the storm. Okay? And you're praying for it to go forward. Now, what happens with a stop, and I've seen this done so many times, certainly on a situation like this. So say you've got a, I don't know, we'll widen the stop out a little bit here. So you're working on a 40 stop, and you're also working on a 3-to-1. Okay. Now this sounds and looks outstanding. You know, and we just change these a little bit. So you, in theory, have to win 3 times out of 10. Okay. Now, with this example, this is even worse than the last one, believe it or not. Because you can be thinking to yourself, oh, hold on a second, I only need to win 3 so I can really be terrible at what I do for a living and still get paid. No, you can't. Because now, what's going to happen if you've lost 7 times in a row? The fear and greed, but more importantly, the fear, as Volker quite rightly pointed out here about stress, is going to be massive. Right? It takes a real strong individual to be able to do that. And not a lot of beginner traders can do it because they haven't got the mental stability and the time on the charts to understand how this works. So that, to me, is absolutely ludicrous. You know, it does nothing to help you win. On paper, it looks fantastic, but in reality, as I said, not so much. So let's change the dynamic a little bit. So the target is still going to be the same, 120. All right. Our stop in this instance is going to be 40, just the same. Why am I doing it like this? Because that's a wide stop and a 40 is a wide stop as well. All right. So originally we're starting with death by 1,000 cuts, but now we're looking at a wide stop based on breadth of market. However, this one is broken up, that one is fully exposed. What's the differences between them? Well, when they are aligned, in other words, placed side by side, fully exposed, nowhere to go, and if that dips down to 30, which was the original sort of double target, all you'll be doing at this moment is praying. You will be going, God's sake, please get me break even. Please get me to the top. And if it did, you'd pull the plug and you'll get out for maybe a quid because you'll be, thank God that made it. Why? Because you got frightened of the market moving down and then coming back up. Human nature, human psychology. However, in this instance, you got out of break even and you got out for scratch just by widening the stop out and letting the market breathe. Now with Scruffy Madness doing it exactly the same way, the parameters are the same, but because you have broken up your position, the risk is significantly less than here. Why? Because down here costs you next to nothing. Your overall profit, if it ran to full target and you let all the positions run, because I'm assuming that it's gone to the worst extreme, gives you a far better profit, and your risk reward is far better. But the bonus to this is that, because if you are sort of having the heart failure moment, oh my God, I can't sit on this heat any longer, I need to get out. And you do get out. You still get paid 80 quid. So to me, that is perfect common sense. And tell me I'm wrong, but it works for me every day. I stage backwards into trades all the time. And well, you see me do it. So happy days. So let's have a look, see where we're up to, and then we'll drop down into the different types of how you can place a stop. Let's have a look. So Volker's typing's terrible. Shocker. You want to see mine? Mine's shocking. Right. Scruffy Madness to me is like eating an elephant. Eating an elephant. Right. I've never heard that one. Right. Go on. Let's have a look at this. You wouldn't fit it all in your mouth at once. Well, I'd have a good go. Have you ever been to a restaurant with me? I'll eat anything if it sits still long enough. Right. You're quite right, Andrew. It's when Madness came into being, I'll tell you a little story about it. I went through the journey just like you guys do. And I chased the money, which you should never do. The trade should be right at the point of entry. And what I mean by trade being right, process over money. The money doesn't matter at this point. And I always thought if you just whack a load of money and you're going to make a load of money. No. I went through the emotional roller coaster of this constantly. And I tried tight stops, just couldn't work. And eventually I figured it out. And then I was told about pound averaging, which is moving into better pricings and everything. There's a version called the Martindale system, which is actually incredibly dangerous. And Martindale is where you will put your position in, goes against you, you double the position, and then double it and double it. Well, you need really big pockets to do that. And if you are wrong, it will wipe you out. However, if I have a single position, a fiver, very rarely I go into the market and the market immediately goes for me. It always pulls back 10, 20 pips, and the DAX can whip back 50 pips in a heartbeat. So I needed to be able to release the stress and understand that this is going to happen anyway. It's just inevitable. You know, it's very rare you catch the very bottom. And if you saw yesterday's video, I gave a little quote for what's pretty famous in the trading world. Try to pick bottoms, you get smelly fingers. It's very true. And that's kind of where my rule of three came from. I don't want the bottom third, don't want the top third, I want the bit in the middle. But that bottom third, if I'm going long, can have a depth of market, and I needed to alleviate that. And that's what Scruffy Madness is. It's just allowing it to go in. And because I'm not interested in the money, I don't care if all the positions are not filled. I'm just wanting it to enter here, exit here, with a stage point to my pain threshold. My pain threshold is something I'll touch on when I get onto two structure points, because I have quite a tolerance for pain. But what I don't have is the patience to be stopped out every time I go for a trade. Hope that makes sense. So let me start looking at different ways. So that kind of a wash version of fixed stops, and then how a fixed stop can be built from an ATR, you know, because if you just go, it's not going to work. But the ATR can help you guide where that stop is going to be. Okay. Now, another thing to do is just have something as simple as a moving average. Now, it doesn't matter which type you use. You can use well, exponential, you could use a VWAP or standard moving average. Don't really matter. But in this instance, you can have it like so. So the moving averages in this instance give you two things. They can help guide your trend. So for argument's sake, say you're going to go long. And why? Well, very simple. If I just pop these over, you can see the black one. If I thicken that up, is a 50. And the red one is 100. So in the simplest of terms, the trend is up. So you will only be looking for buys because this is above there. So where do you hide your stop? Well, you just hide it on the other side of this moving average. So if you were going to enter on this candle, just for argument's sake, you have your entry point here. Your stop, we pull that in, can be hidden there. Now, it doesn't matter what moving averages you use. You could use a 20 and a 50, 50 and 100, as in this case. If you're going down the time frames and you want to be really super tight, you could have two moving averages to give your trend. So if we take this down to an hourly, just for argument's sake, get rid of all of this. And we're going to alter these rounds somewhat. You can see, right, I am having an 8 moving average as a trigger. I am having a 14 moving average and a 21 moving average as my direction. And you would look at it something like this. There is your trend indicators telling you it's going down at this point. You have a trigger telling you when to get in. How was that? Well, you've seen it before. Pushes away, comes back, tags, and the next close down gives you an entry. So you would enter on something like this. There. Why? Well, you can see the push, you can see the retest, and then you can see the close back underneath. So you enter here. Where do you place your stop? Well, it's devil's advocate. You can either use this as a very tight stop or on the other side of here. Very, very simple. Just like so. And then as the trade moves with you, you follow the stop behind the moving average. Just like so. As that trade moves down. And that's about as simple as it gets, because you're not putting any thought into your RRs. You're not putting any thought into your position sizes. You're just placing the stop in a logical place that can protect the account. Now, when you're looking at protection of account, that comes down to position sizing as well. Because straight away, if you've only got 100 quid in your account and you're doing a £5 a point, that account ain't going to last long. It wants to be like 10 pence or something. So again, it's common sense and relative to account size. It's why I don't look at percentage of account. I look at money. all the time. It's money. So I know how much I want out of it. I'll break it down to 200 quid a day. I'll break it down into a couple of trades, and then that'll give me my position size. And if I think the position size is too big for what I'm putting on, then my original target was unrealistic in the first place. And it's just a way that I look at things. So that is an easy way to do it with a moving average. And like I say, keep dropping it into the comments, and I'll keep reading them as I'm going, and I'll stop and I'll answer them as we go, because I'm going to pull up a Donchian chart as well. Okay, so when a logical stop loss is a bit too far away, do you skip the trade? In essence, yes, is the answer to that one, Volker. When we were first looking at charts and one thing and another, I always go into the chart thinking to myself, I'm right. I never enter a chart like that. Okay, I always wait for certain conditions, and you've seen me do it 1,000 times, and it's always levels, and I'm working between pockets of air. Okay, now if there's a massive pocket of air underneath where I'm going to enter a trade, I'd do one of two things. I'd either reduce the position size right the way down. So if I was at a 5 or a point, and the stop or the next logical stopping point, which is normally a level or a point of attraction, is so far away, I think it would destroy the account. I would half the position size so that I can allow for the bigger stop. Hope that makes sense. So my monetary value is the same. So if there was a 100 pip stop at a pound, and I needed that stop to be 200 away, I would just reduce it to 50 pence. So my money is the same, but it allows breadth of market. Hope that makes sense. So happy days. Right, so let's get rid of this lot, and we'll move our way down. Get rid of the moving averages. Now, I don't know if you've come across this before, but if you're looking for a very quick way to work the market out, it's this thing. It's a Donchian channel. Okay, I'll thicken it up a little bit so you can see it. Now, you don't need the middle bit, not so much as the outer extremes. Now, what a Donchian channel does is it counts back however many candles you've set it to. In this instance, it's 50. Now, depending on what you're doing, you could set it for 100 back, you could set it for 20 back. If you want to be tight in the volatility, you could even drop it down to 10. Personally, 20 to 50 is probably the right way. Okay. And again, what you're looking for is the breadth. It's breadth of market. And it shows it to you in an instant. So if we are looking for whatever reason to get into the market here, and we've decided that it's going to go long, well, you place your stop on the other side of the Donchian. Why? Because that's the lowest point of the last 50 candles. And if you're trying to time the bottom, it'll help you. But likewise, if you're going the other way and you think, well, I'm going to continue to move down because we had our moving averages on and that was saying you go down, and you want a super wide stop, it's up here. But if you wanted to tighten it up, pulls it in. And as you can see, that is the logical point up here. Why? Because if we go on 2 swing points, well, there's one, there's the other, and there's the logical point. Simple way of doing this. And I genuinely, I'm trying to make this as easy as I can for you guys. And stops, I don't know. You tell me in the comments. Do you like them tight? Do you like them wide? Are you just guessing, or are you trying to use some form of a market structure? I'll be interested to see how you do it, because the one thing that I hear over and over is, oh, just put it on the last swing high. But why? Surely that could be retested, and that's it. So let's have a look. I mean, making set short on the DAX. Yeah, short on the DAX. That's not a bad thing. Get it off the weekend. Don't want that. Standard. There we go. All right. So there's your Donchian channel. And what's it showing you? Well, if you're going down, there's a swing high. There's the second swing. There is your stop. Simple stuff. And it doesn't matter what market it's on. It'll work. Or if you go 50 back, obviously it'll change the dynamic slightly. It'll put it right up there. So in this instance with the DAX, the DAX is such a brutal market. That would be way too high. You know, because if you let that run all the way up there, it's like, it's a world of pain. But if you pull that in to 20, then that's reasonable. 1, 2, or 1, 2. Depends on how you look at it. Now, in there, Andrew said some breathing space is always good. And that's a big debate in itself. What do you constitute as breathing space? What do you think about that? See, some would just go in and say, right, I'm not putting a stop in at all, and away we trot. That's not breathing space, that's stupidity. Because Friday was a classic example of a black swan event that would just cripple you. Down it went. Now, it also creates a good opportunity, because when something goes down that quick, it's going to have to retrace pretty quick as well. It's where your fibs come into play. And in fact, a fib, just to sort of use it as a point of reference as well, we'll find a good contender for that, where there's a big drop. Nice big candle. If you're looking for a retracement. Must be a decent move there. Okay. That's relatively steep. Well, there's a relatively steep move. All right. We can see it. We can recognize it very quickly. All right. Why? Well, it's sustained. You get a fib and you draw a fib line on it like so. And then again, you're looking at basic structure and letting a fib help you guide. The one thing I tell you guys all the time is a fib can give you an entry, an exit, and a stop. Well, we have an entry here. Why there? Because it's the 23. It's letting the chart tell you what it's going to do. Not the bottom third, it's not top third, it's the bit in the middle. And then we have our exit points. Whoop, just take that off. Point of 38, 50, 61. Right. So what's this got to do with stops? Well, if you go on to retrace on yourself, we know this is the top. That is your breadth of stop. In other words, where you'll put your scruffy madness. and your stop can sit on the outside of it. Now, I like a bit of a wider stop, so you can drop an extension into it, just like so. And it gives me a final stop here. So in this instance, widen this out a bit so you can see it. You've recognized the move and you've seen the drop. All right. Very, very simple stuff. You've placed your entry on the 23, and as you see, it retests it over and over. This is the enter zone between the 23 and 38, and your exit zone is between the 50 and the 61, and your stop zone is up to the 127. And the way that you would sort of think this one through is very simple. If this breaches the top of here, you start thinking, am I wrong? If you believe you are wrong because there's a change in sentiment, you just get out. Why? Well, what's the point of letting it run up there? You're wrong. You know you're going to get hurt. So just cut your losses. If you are unsure, you can say, well, I'm going to close half my position up. And then that way, if you are wrong, it's only cost you half as much. But if you're right, the bit that you left on the table can pay off the loss. Or you do Scruffy Madness all the way up to 127. And that means it'll scale in and reduce your risk. Soon as it breaks the 127, you have a final hard stop, maybe 5 or 6 pips behind it. And that'll make the decision for you. So that's using a fib as a stop based on a retracement. And it can work the other way as well. Because if you think to yourself, in this case, I was only going to go long, you've drawn your fib on here, your entry points start to become this area here, which is the 50 to 61. You're expecting it to come down into here and turn around. You can widen that out to the 38, which is what GoldenEye is. GoldenEye is an exit and an entry point. And then you use the bottom section in the exact same way you've used that. So if the stop comes down into here, you are wrong. Do I get out? If so, you have your madness set in place and then you catch the move. Very, very simple. They're just different ways of looking at the markets, guys. Now, if I clean all this down and we start looking at pockets of air and 2 points of attraction, it might help us. So if I have some levels in play, we have one here, there's certainly one there, and there's a reasonably solid one there. Okay. The first thing I'm doing when I'm coming into a market, and in this instance, we're just going to assume that it's going up. There is my trigger point. Why is my trigger point there? Well, it's a level to start with. So that's the first thing that I'm looking at. Let's just drop on a Bollinger Band just so I can highlight something here. So there's my trigger point. All right. For no other reason, it's at a level and it's gone green. And I want to move it up. I'm now looking for pockets of air. Now for my target, it is the next logical level or the top of the Bollinger Band. Why? Because there's nothing in its path. And that's all you're looking for all the time. When you want your targets, you go up to this point of attraction. That's what that is. The base of a Bollinger Band is a point of attraction. a moving average is a point of attraction. You know, it's a point of interest. Now, I like 2. So if I'm looking at this and I want it ultra tight, well, there is the first swing point. So that's point of attraction 1. Why? Well, because if I'm entering up here, there is the roadblock, and that's the swing that lives with it. But will this be tested? It's a high probability it will be. Why? Because markets do it over and over. Here, there, test, 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 away. Here, test, 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 then away. They do it over and over. And that's why I like 2 points of attraction. So the second one would be a level or the other side of a Bollinger Band, out of the way. But I want 2. Always 2. Now this could be a bit tight, but looking at it, it's not. You know, that is quite a hefty. So from an entry point up there down into that level, well, in this case was 165. Where else could I have figured this out? Right back at the start, the ATR. And then that goes back to Volker's question about, would you take the trade if it is out of the ordinary? Well, if my ATR is in line, and then I look at a level, and I look at, well, in this case, a swing point and a level, and then at the bottom down here, it'll be another level and a Bollinger swing point, 2 points of attraction. If they are in line with what the Bollinger Band, the ATR was saying at the start, it's probably a good trade. However, if that was 300, and we know the ATR on the DAX is roughly about 150, it's 150 to 200. I'm not sure what it is at the minute, actually. Let's have a look. Let's see what the ATR is today. Well, on the hourly, let's have a look. Go to the daily. Let's have a look. Well, it's been running at 276. It's way naughty at the minute. So in that instance, going back to that example, it's well in tolerance. So you tell me, is that good? Is that bad? Indifferent? I don't know. So let's have a look, see what we've all got to say. I think most people have tried the DAX, yeah. A lot of people like the DAX. It is a bit of a scary market if you're not used to it. If you've got small accounts, it's a bit rough. Always used to go as tight as I could. There's nothing wrong with tight stops as long as you can understand what the pain threshold is, Steve. Like I say, it's the great debate. Should it be tight? Should it be wide? Well, there's arguments against for both, but there's also arguments for both as well. Personally, I haven't got the mental stability to be able to sit through 7 or 8 losses in a run and just watch my account deplete, which is why I use a wider stop. But at the same time, I'm sensible enough to know that I might have a wide stop, and sometimes I'm going to get a bloody nose, you know, and it's going to hurt me badly. However, the amount of wins that come before it build up a profit cushion that can offset a major kick in the nuts. All right, and that's kind of my thought process, and helps me calm it down a little bit. So I like using them wide Scruffy Madness. Well, Scruffy Madness, Steph, is designed for a wider stop. But like I say, there's a difference between sort of wide and stupidity, you know. But you could run it, for argument's sake, into 50 up to sort of 80 pips away. as long as it's in line with your ATRs, etc. Because the markets will run around throughout the day, you know, and you see it. You'll see them rotate quite regularly. Certainly on London Open, for argument's sake, it can run 50 pips in one way and then 50 pips past the other way. So it's actually moved 100. It just swings round constantly. Just got to be a little bit careful with it, that's all. Okay, closed off my position on cable and still in it. Well, that was wise. I wouldn't like to predict what's going to happen on Monday morning. I have been watching the weekend markets on it. It looks like it's run out of its steam. And anything that moves that quickly has to retrace at some point. Why? Well, people will be taking profits and people are caught on the wrong side of the trade getting stopped out, which forces the market. So who knows? Could be a good bounce on Monday sometime. Right. Ryan, do you prefer to trade the retracements or trade in continuation of a trend with it? Right. When it comes to fibs, I'm pretty good at getting retracements. I like retracements. Why? Because they're normally quite violent and quick. But the trick with it is not to outstay your welcome with them. And when you watch me doing it with the DAX and one thing or another, I'm in and I'm out. I'm in and I'm out. Pretty darn quick. But it is based on a retracement. Okay. But if there's a strong trend that I can see, and it really depends on the trade setup. For argument's sake, if I see a strong move like so, strong directional move, I will automatically look for the retrace. Why? Because, as I've just said, people are going to get caught on the wrong side of the trade. People are going to have opposing positions. It'll snap back. And that snap is normally reasonably, well, you're going to hit 50%. So if you target between the 38 and the 50, about midway, that'll allow for the spread. And it's normally a good trade. Because one thing, just case in point, there we are there. All right. Slam straight in and then off it pops. But if I was going to be continuing the trend, in other words, I like the idea of this, I'd be looking for a retracement. That's, well, let's see if we can find one. That's not, there isn't one. Not particularly there, for argument's sake. That's not really a strong directional move. It's just a sustained move, but it's quite gentle and easy, and then it dropped off. In a situation like that, I'd be looking for an entry point around the 50, sort of the pull back, get in, and then carry on. But in something like this, where it is absolutely sustained in one direction, and certainly something like that, where it's an overextended candle, I'd be looking for the retracement. Okay. So let's have a look. Do you use the daily ATR to work out your own? I certainly do, Yanis. I certainly do. When I'm looking at an ATR, I always look at an ATR based on a daily. Because what I'm trying to achieve is breadth of market. Because whenever we look at a market, we can have an idea, but we only know what's happened in the past. You know, it's an echo of the past, vision of the future. Whatever's going to happen in the future, I don't know. So at the beginning of the day, I want to know what the breadth of market is. And then that gives me, and you've heard me say it, a trading arena. And as long as the price stays within that arena, all I have to do is find the here and now direction. And that's kind of where you see fast RSIs. You can use your moving averages. Your Bollinger Bands help you with the stretch points. And then I'll work within that sort of framework. And then within that breadth of market, maybe certain levels, which give me an even tighter arena. And it just works like that. And then you can look at things like your daddy levels. For those of you who are unsure what a daddy level is, let's get rid of this. I'll get rid of the Bollinger Band, and I'll quickly show you what a daddy level is, because that's relevant for today as well. So for argument's sake, here is a day, one day. Now, when anybody looks at a candle to start with, they think there are 4 pieces of information. There's not. There's 5. And those 5 pieces is this. So you have your highest point. Just put these in black. Your lowest point. You then get the open and close, which are either side of the candle. And for newbies, that would be the open, that would be the close, the highest point, the lowest point. But there is also the midpoint. If I just get my measuring tool out, measure that up to the top there, and drop that in purple, just like so. All right. These levels are what's called daddy levels. It's a little nickname that was given to them because they are the father of time. And when you're coming into your next day, this is the child of this candle. And this candle here, just like any father, will show the way. And what does it do? You plot these many times, you'll start seeing breadth of market. Well, there's breadth of market from the day before, and attraction points that'll be revisited. Well, the midpoint's revisited. It hasn't come down here. So if you believe that this market is going long and you're working on stops, again, you can drop it under there. Simple stuff. But they can also help you with points of attraction for targets. You know, it's all very simple. So if you come into this, you target the middle. If you're down in the middle, you can target the next one up. And again, it all adds layers of confirmation time and time again. So there we go, guys. Been banging on for about an hour. Somebody's shouting for me. Fire your questions just in the last minute or two, and we'll wrap this up. So let's have a look, see what we've got. So anytime, Ryan, anytime. With daddy levels on a weekends, do you count Saturday trades or combine? No, right. That's actually quite a good question, to be honest. I disregard weekends completely. Even Sunday, I don't really look at it. Monday to Friday. Why? Because they're the true trading days. On a weekend, when you're seeing the moves, they're kind of synthetic and they don't hold a lot of weight. Are you having fun with crypto? Let's just call it a brave new world, Ryan. A brave new world. And wherever Alex is in this chat, when you come to Durham, I want to kick you right in the bollocks. Because it's done my head in this last week. And the drinks are on you, my kid. They really are. Oh, actually, I'm enjoying it. It's... I find it a little bit like the Wild West. And if I was to define, it's like a game of two halves, if you like. Yeah, you have the big sort of cryptos, your Bitcoins, your Ethereum. They are almost like Forex markets in the sense they've got a lot of money behind them and they move okay. But then at the bottom end, the altcoins is like the stock market. And it's almost like looking for that penny stock that's going to pump and dump. And it's almost like a lottery. And I'm kind of having a few headaches with it. But at the end of the day, a chart is a chart. And it's about money flow coming in and going out that moves those charts. So fibs will always work the same. Levels will always react the same. The indicators, I'm finding that them a little bit odd. The MACD isn't too bad. I might do a video on the MACD actually. My fast RSI is okay. But ultimately I read the candlesticks. So there we go. So happy days. So where else are we up to? Daddy levels. Yes, daddy levels are... They're a good guide. If you have nothing else on the chart and you put your daddy levels on, they'll give you some points of attraction to work to. And that's it. So I hope that's been good for you. Genuinely do. And like I say, if you're stuck, I'm always about. I did have a bit of a rant on Friday. Resolved that by telling them exactly what I think. Common sense, guys. Common sense. I can give you the tools, but you have to use them. All right. So I hope that works well, and we'll be back at it at 6 o'clock tomorrow morning. So have a good one, guys. Catch you all soon.